The Money Society. After experiencing one of the worst years for global stocks in more than a decade, and a significant downturn in the bond market, investors are understandably wary of potential risks that could cause further turmoil in the markets in 2023. While some are optimistic about the possibility of central banks cutting interest rates and China fully emerging from its COVID-19 isolation, as well as the potential for conflict in Europe to subside, others are on the lookout for potential threats that could disrupt the markets. One potential scenario that could cause issues for investors is the risk of rising inflation. Matthew McLennan, co-head of the Global Value Team at First Eagle Investment Management, warns that there is a real possibility that wage growth and increased energy costs could continue to fuel consumer price increases. If this were to occur, it could rule out the possibility of interest rate cuts by the Federal Reserve and other central banks, which many markets are currently anticipating in the second half of the year. This could result in further declines in stocks and bonds, an increase in the strength of the US dollar, and further challenges for emerging markets. McLennan also notes that higher borrowing costs could potentially trigger a recession, leading to further difficulties for investors. Another risk to consider is the potential for setbacks in China's economic recovery. Chinese stocks have seen a significant increase of approximately 35% since their October low point, due in part to the anticipation of the world's second-largest economy fully reopening after lengthy lockdowns. However, there is a danger that the country's healthcare system could be overwhelmed by a surge in COVID-19 infections, leading to a collapse in economic activity. This could impact the fragile rebound in Chinese equities, and could also decrease demand for commodities such as industrial metals and iron ore, which could be a significant risk for countries such as Australia. The ongoing conflict in Ukraine also presents a potential risk for investors. John Vail, Chief Global Market Strategist for Nikko Asset Management, warns that if the war were to worsen and NATO were to become more directly involved in hostilities, it could lead to increased sanctions and be a major negative factor for the global economy. This is particularly true if secondary sanctions were imposed on Russia's trading partners, including India and China, as it could amplify the effects of current restrictions at a time when the global economy is already vulnerable. Vail adds that a more extreme scenario, albeit a distant possibility, would be the use of a tactical nuclear weapon by Russia, which could completely halt Ukraine's agriculture exports. A further risk to consider is the possibility of a more contagious or deadly strain of COVID-19 emerging. This could lead to renewed lockdowns and further disruptions to economic activity, potentially causing a decline in stocks and bonds and increasing the strength of the US dollar. Shane Oliver, head of investment strategy and economics for AM, notes that this could be particularly difficult for emerging market countries that have a large amount of debt denominated in US dollars, as they would face an even heavier burden of debt. Overall, it is important for investors to be aware of the potential risks that could impact the markets in 2023. While some scenarios may be more likely than others, it is crucial to consider all possibilities in order to make informed investment decisions. Thanks for watching.